I'm back. We're on chapter 17 now, financial management. I wanted you to go back to page 6 before you read this chapter. You didn't have to read this whole chapter, by the way. For this course, we don't get into everything that's in this chapter. But I wanted you to go back to that page 6 and keep those factors of production in the back of your mind when you're thinking about financial management. Because everything that we do in financial management really has to do with these factors of production. How do we afford the capital that we need? How do we afford the human resources that we need? What's our infrastructure? Those kinds of things. So, starting with the overview, you have to keep in mind that what companies are here for. We're here to produce goods, right? We're here to market them to someone, get them somebody to buy them, right? And then the last part of this whole deal is we have to manage our money. So that's the financial management part of this. It's highly specialized. That's why we hire accountants, CPAs, bookkeepers, and all that kind of thing, because this is a very highly specialized area. A larger company is going to have someone who is the finance guy, the CFO, right? Chief Financial Officer. That's why we have these positions. It's very complicated. In this chapter, we're just kind of, looking at the basics. So we're going to kind of like move forward and just look at the financial planning part, which is the responsibility of the financial manager. Okay. So financial planning, this is a huge part of your business plan. It's probably the most important part of the business plan. So when you guys write your business plans, if you're in the business management program, for example, you're going to need to pay close attention to this. You need to understand what it is that we're going to do financially to support the business and prove that we're going to be successful. So this is one section of your business plan. Okay. Now we have short-term plans and we have long-term plans financially. So short-term financial planning, we generally call those operating plans. Okay. And then long-term ones, those are long-term forecasting plans. Those are our strategic plans. So short-term financial planning and long-term financial planning. We do both. And what you're really trying to do is find a balance in all of this. And if you look at that section in the book that starts financial planning, they talk about, like what funds will the firm require during this planning period, this short period or this long period, right? When will it need additional funding? Where will it get the funding from? Okay. So preparing a financial plan, like I said, it's complicated, but you can break it down into some basic steps. First thing that we need to do in a financial plan is try to estimate our future sales, right? Sounds easy? It's not. You have to, again, look at these markets, look what's going on with your product, look what's going on in competitive areas, economic indicators, all those kinds of things. So first you try to figure out what your estimated sales or revenue is going to be. That's like the first part of the financial plan. So once we know that, we can say, well, I wonder how much we'll make profits then. So then you try to forecast or estimate your profits. And then the last thing that we do as part of our financial plan then is to try to decide what's it going to take to meet this expected demand. So let's say you have your estimated sales, you figured out what your profits might be. Now you have to figure out that last step is, okay, what do we need to do this? So do I need a bigger building? Do I need more equipment? So far, this is how much we're doing, but like we're maxed out. Let's say this is a fancy pants restaurant or any restaurant or whatever. And you can kick out X number of dinners per evening, right, on a Friday night or a Saturday night. For you to be able to double that, what kind of equipment would you need? You'd need more staff. You might need an add-on to your kitchen or whatever it is, right? So that's the other part. That's the third part of this. So then estimate the sales, estimate your profits, and then what are we going to do to try to meet those needs? That's the planning part of it. So now what do I have to borrow? What do I need to do to get there? The bottom line of this, and the book talks about this too, is about what it means to have a good financial plan, is to try to have financial control over the process, right? Make sure that you're comparing your actual revenues and costs and expenses with the forecasts. look at the differences between what's happening now and what's happened, a month ago or last year. That's why we keep track of all this stuff, right? You should be making comparisons year to year. My goodness, of course. Then you can see if there's seasonal fluctuations. And okay, my goodness, I didn't realize that, fall was going to be my season. You should have realized that, depending on your product. But maybe you didn't quite know how big it was going to be. So now you say, well, okay, for next year, we really got to gear up towards, like right now, where are we at now? We're coming into the Christmas holiday season, right? So you'd think about that. So now we're going to do all that, right? We got the plan. We're making our comparison. So I said, okay, so then, how do we manage these assets, right? The book talks about our assets because there's short-term and long-term assets. Now, when you look at short-term assets, we're talking, and whenever we say short-term in business or finance, we're usually talking about a year or less-ish, 1 to 2 years at the most, but 1 year life-ish, okay? And one way to help explain this, I think, when we talk about managing assets, well, either short-term or long-term, but that business etiquette section in your book, tips from LearnVest. I thought this was really interesting. And this gal set up this website designed to help young women improve their financial literacy, right? This is a whole different vocabulary, the whole 9 yards. And she had that 5 points. Now, it doesn't matter if you're looking at this as a personal example. You could apply the same points to a business example. So here it says, do open a retirement account and establish a relationship with a reputable financial planner. Well, you do that in a business, right? You're going to set up different accounts, whether it's capital investment accounts, short-term, long-term, all that good stuff. And you're going to be using a professional to help you do that, right? And maybe if you're a big company, you're going to have a CFO. Setting realistic goals and backing up with realistic strategies. Now, in this case, she said maybe those 3 strategies: eat at home, avoid the dry cleaner, right? And carpool. You do the same thing in a business. She talks about not going crazy with the online shopping. Well, we can do the same thing. If you have a line of credit in your business, don't go crazy and buy a bunch of stuff. You have to plan for these things. The 4th point, she said, don't count on your tax refund, holiday gifts, or bonuses. Same thing in business. There's nothing free in business, right? Coupons, great money savers, but use them wisely. Again, anything that sounds too good to be true probably is, especially in business and finance. Anything that sounds like, I'll borrow you all that money, it'll be free. I won't charge you interest. Oh, no, there's nothing free in business, nothing. So be mindful of those things. So the same thing applies in business. Now they talk about cash and marketable securities. These are just low risk financial tools. And these are just to help you pay those day-to-day expenses. That's why they're short term. Your accounts receivable is another one of these. But to do that, if you have accounts receivable, now accounts receivable means that you're borrowing to people, right? Or they're buying on credit. You're having credit sales or whatever it is. That's where your professional comes into this, because you have to have, what's your overall credit policy, right? And then who do I offer credit to? So generally we check people's credit rating, right? Because I really don't want to borrow to the high risk people, right? That don't pay us back. And then we use different tools for doing that. I think this textbook talks about, where was it? Oh, they were talking about calculating your turnover, your accounts receivable turnover. And that's a tool that we use in financial management to see how fast we're recovering our expenses, right? So when we borrow it out, how quickly are we rolling that over? If it's too slow, you probably have a problem and you need to fix that, okay? Inventory. Biggest mistake I saw when I worked with small businesses as a consultant was the mistakes that they made with their inventory management. Most businesses make the mistake. Small businesses are notorious for that. That's why we need to really watch our inventory turnover. How fast are you turning your inventory? If your inventory is sitting on the shelf, you have to envision in your mind that they're dollar bills. So how long would you let a big, ginormous stack of green dollar bills sit on your shelf, right? How long? I would hope not very long, right? Well, we let inventory sit forever. So that's why we're always trying to move our inventory, and that's where we got into that whole just-in-time, right? JIT, just-in-time inventory control systems. There's a lot of money that sits in our inventory. Companies are pretty good about it now. I mean, we have big companies are really good at it, right? Smaller companies tend to not be so good at it because they haven't studied this well enough, or maybe aren't working with a professional and learn how to use that to their advantage. All right. Now, capital investment analysis. There's the next section the book talks about. Now, this is the stuff that has over a year. That's why it's called capital investment. That's over the life, over 1 year life. It's not necessarily short term. And that's where they talk about like managing international assets, things like that. Well, that can be really hard to do because there's different exchange rates. So what a building has a value here may not have the same value there. Same thing with inventory. It gets a little tricky. As you can see, there's a lot of things going on that you need to be aware of where all of this is concerned. Now, then they move on to the sources of funds and your capital structure. Ooh, our old friend, the accounting equation. Should have recognized that right away, right? Look at it, hasn't changed. It never changes. Assets is always going to equal liabilities and owner's equity. But there's different kinds of equity. There's debt equity and there's equity capital. Say that 39 times in a row. And those are the two ways we can fund our businesses, through debt funding or debt capital and through equity capital or equity funding. And the book gives you the basic definitions and all that good stuff here. Every company is going, and this is a balance, by the way. We don't generally use one or the other. We don't just generally use debt equity versus capital equity, that kind of thing, or two kinds of funding for our business. It's all about finding a good balance. Every company is going to have a different approach. It often depends on the industry, and I think your textbook gives you some examples of different industries and how they balance this out, how they mix up how they're going to fund their businesses. And then they give a good example under that section in the book called Leverage and Capital Structure Decisions. So borrowing, this is basically talking about borrowing. How are we going to borrow money to support our activities in our business? You can have a leverage approach versus an equity approach, right? If you look at figure 17.2, they put this in a diagram. So we have what they show here, and I'm looking at it here, the leverage company. This is where they're getting 50% of their funds from lenders who purchase company bonds, okay? That's a little more risky, right? Versus the equity company, on the line with the yellow dot on it, the equity company raises funds through sale of company stock. So here's the basic difference. If you're looking at this diagram, looking at this table here, you can see that if your earnings went from the 10, and the book walks you through this as well, if your earnings went from 10 million to 20 million, you can see how that's exactly the amount of earnings the equity company increased by. They went up from 10 to 20% increase. But look at the steeper leverage company, how that changes. From 10 to 20 million in earnings, that increase goes from 10 to 30%. And you're thinking, whoa, I'm leveraging. I'm going to be a leverage company. Remember, there's nothing free in business. There's more risk with doing that. So make sure you just take a look at the disadvantages the text talks about. Anything where you're going to get that higher of a return, I don't care what it is, whether it's funding or the stock market or whatever, you are going to take more risk. And there's always the same relationship if things don't go well. So the same thing's going to happen if you went from 10 million earnings to 5 million earnings. The equity company is going to have less loss than the leverage company. If you have a higher gain if things go well, you have a higher loss if things go bad. Okay, and this is the way it plays out. Mixing short-term and long-term funds, again, is just like finding a balance in anything. And that's where your financial planners, your financial experts, try to figure out how to do this. So it's like, so how do we mix all of this up? And then decide what to do with our money. So you have dividends, right? We have dividend policies, right? We have to decide if we're going to pay dividend. Now remember, there's no law that says I have to pay dividends at all, right? Now some do, like what the textbook talked about, regular dividends, right? Those are like maybe automatically paid quarterly. Well, a lot of companies don't do that, right? So there's no guarantee that you're going to get a dividend. And then let's look at the short-term funding options. Short-term funding, again, repaid within a year, right? Versus long-term, which is, over a year, right? We have different ways to do that. There's trade credit, for example. Now, this is kind of interesting. Don't think it's nothing too fancy. Trade credit sounds very fancy. Basically, it means you're sort of borrowing from your supplier, and you're not really technically borrowing. Just like they might give you 30 days to pay your account, right? So whatever it is you order, they give you 30 days to pay it. Now, they can have some stipulations where, oh, listen, if you pay me cash, give you a little discount. Remember, nothing's free in business. You're going to hear me say it until you're sick of it, right? If I'm going to give you a discount if you pay cash, if you don't pay on time, I'm also going to penalize you. So I think this text talks about maybe 24% or exceeding 24%. That's huge. Okay, so make sure you understand the terms of your credit. Short-term loans. These come from banks. You've heard of lines of credit. You can get a line of credit for your business, or you can get a revolving credit agreement. And again, you need to sit down and look at the terms of these agreements. They're all going to be different. You can read the different sample or examples that the book gives us. But basically, a line of credit is just that. You'll let you borrow this much for this length of time. You got to pay it off. The revolving credit agreement means it's on a revolving basis. But again, you're going to pay interest on these things. So make sure you understand the terms before you sign on the dotted line. Less known maybe to obviously for smaller businesses, commercial paper. Basically, that's an IOU. That's just basically an IOU. And they are in large increments, starting like at $100,000. So small businesses, we just don't usually bump into that very much. Sources of long-term financing. Again, now that we're talking about, over the long term, longer than a year. These are for major investments. Maybe it's a building, that's going to take you a while to pay that baby off, right? So we can do public sale of stocks, private placements, venture capitalists, private equity funds. Oh, venture capitalists, think tank. Or is it, no, Shark Tank. Think Shark Tank. That movie Shark Tank, or reality TV, Shark Tank. That's where you get those venture capitalists involved. Now, whenever you hear the word private, that's just what it means. These things aren't going to be open to the public. These are to either small investors, individual investors, or small investment groups. What I find interesting is the way, and the last one is hedge funds. And there's a small segment there on hedge funds. And again, these are basically private. I'm not a big fan of that whole. I get really worried about those because they're not regulated. And we saw what happened over the economic crisis that we had from starting 2008. Hedge funds played a big role in that. But one thing now, we're having crowdsourcing, which is so fascinating, and that's what's new and upcoming. So, and that's not in the book. Obviously, it's not in this either our textbook yet. But so go ahead and look that up on your own on crowdsourcing and how you can fund your business without the use of any of these financial tools. So there you go. That's my spiel for this chapter. Until next time, have a great day.